Welcome, everybody, to another episode of the Good Deeds Note Investing Podcast. I am Jamie Bateman. I'm joined by my co-host, Chris Seveney. And today we have a special guest joining us as well. And we're happy to introduce Fuquan Bilal from NNG Capital Group. Fuquan, how are you doing today?
I'm doing great. Thanks for having me on the show. I really appreciate it.
Absolutely. Yeah. Go ahead, Chris.
Fuquan's got a lot more energy than you, Jamie. You're a little, discombobulated this morning.
I had to move to the basement. I've been relegated to the basement. So, overcoming obstacles, that's what entrepreneurs do, right? So
every day, all day.
I've been in the basement the last year plus, so I'm used to it by now.
Yeah. The next stop is the shed for Chris, but just kidding. So yeah, Fuquan, we wanted to have you on for multiple reasons, but one is that I think you play more in the second mortgage space, and Chris and I dabble a little bit more in the first space. That's one reason, but I know you have your hands in a lot of different things and you're very experienced as far as real estate and rehabs and note investing and all kinds of things. So for the audience who's not familiar with you, do you mind giving a little bit of your background for us?
Sure, thanks. So first of all, I'm a superhero to my kids. I always start off with that. That's first and foremost. And it didn't used to be like that a long time ago. I was a slave to money instead of being a master of it. Chasing the dollars, never ending. When I first got into real estate, 21 years ago now, I started in '99. I jumped out the window and grew the wings flying down. Left my corporate job, started doing fix and flips from '99 all the way to the bubble burst in '08. And, got my behind handed to me, got punched in the face, had to start all over again. Went through a divorce, went through all the stuff that you can think that happens when the well runs dry. Had several different businesses, 54 employees at the time, anywhere from transportation services to a car wash, a variety of different businesses. After that, I really had to do some soul searching because real estate was something that I've always been in sales and it kind of kept me alive. And when the market transitioned, I had no idea what to do, how to move forward. So that actually made me the better man who I am today because I had to go deeper within and really do that self journey and started meditating and everything else and started to attend more real estate events because, I thought I knew it all at the time. I was young. I was a millionaire when I was 28. So at that time, I was just like, thought I knew everything, didn't need the help. When the market crashed, that kind of taught me a lot of new lessons. And I started to now go out to real estate events just so I could be abreast of what's happening in the market. And I could have some type of idea or foreshadow or be able to navigate by staying in tune with the market. Doing research around about 2011, I discovered the note business and I fell in love with it. My first presentation that I saw, I had learned about partials. I learned about collateral assignments and how you can hypothecate the note and borrow against it. And it was a paper instrument and you didn't have to deal with contractors. I was like, wow, this is amazing. And, I started off in seconds because at the time, a lot of people didn't know about notes. People know about seller carrybacks, the old traditional notes that you do when you're selling a house. You might hold back a second or a portion of the note or finance a deal for someone. But this was a different arena. This was institutional paper. And I had no idea that, someone like myself can have access to this, right? I always thought it was the big hedge funds. And I discovered that at that time, the banks were the bad guys that they were foreclosing. So they were selling paper out the back door, so to speak. Just to get it off their books to kind of clean up the losses that they had, to try to trigger some of that money from the TARP that was out, the Trouble Asset Release Program, that they had to, do certain things in order to get to that money and look good in the eyes of the people on the Hill. So we got access to the paper and we started to experiment with it. I put $100,000 of my own money. I went into seconds because it allowed me to create diversity and get more for back then it was like 10 cents in a dollar, 8 cents in a dollar that you can get stuff for, especially in Florida. Nobody wanted Florida, New York, nobody wanted judicial states. So I went out, bought some loans. I made 40% returns in less than 10 months of 4 different deals that I did. And it was a variety of a discounted payoff, a short sale, getting some arrears on a down payment and getting a reperformance. So there was a lot of different ways that I learned that you can actually generate income from the note business. When I discovered that, I had case studies and I was able to go to some of the people who invested alongside of me in real estate and show them these case studies of deals I've done with my own money. Got a few partners, started to do more deals, and fast forward to 2013, I opened up my first note fund. And I just stayed laser focused on that for the first 2 years. The note business was new, it was exciting, it still is exciting to me. And I just learned so much. And I wasn't doing much real estate then. I was doing one or two here projects because I already knew how to do it. I already had contractors, resources, so I didn't want to stop at 100%. So I did that a little bit to build up my own personal portfolio while I focused on the fund with the notes. And fast forward today, I have a hybrid model where I invest in notes and real estate. And I think it's important for every investor who have some knowledge of real estate not to just be laser focused on one thing. Of course, you want to build mastery in it, but once you build systems and processes and you can have an integrator or somebody run that for you, you can start to investigate other things because you got to learn how to pivot. 2015, I started writing on the wall. Everyone was getting into the second mortgage space. Guys from the first was going into second because they couldn't find any deal or things that they used to find pricing was going up, and they heard a lot of great things about seconds and they started to explore it. There were people who was raising cheaper capital coming into the space, so pricing started to go up, right? And I started writing on the wall, so I started focusing more on real estate in 2015 than notes. Now I still did trade smaller trades than what I was used to, but I still kept it going, getting the pipeline going, filtering notes, stopped selling notes, started to work them out because we started to see more profit exiting through the borrowing. That's been our biggest opportunity is helping the borrower stay in the house, and also it becomes more profitable because you can create payment streams that you can do partials, collateral assignments, and stuff like that. And then in 2015, I started doing way more real estate. The banks that was selling me paper, I started to reach out to the REO division and finding out what did they have in my backyard first, things that I was used to, areas that I knew, and started to be able to buy bulk REOs from them and just started rehab mania all the way into now. And in 2019, December 2019, I knew something was coming. I didn't know COVID or the Black Swan event, whatever they call it, was going to happen. But I knew something was coming. I've been in the business long enough, and I was a part of different masterminds and networks that was saying it's something that's going to come. The market is going to reset. It's been good for too long. You have to pivot. So I created a fund where now it's a hybrid model where I'm able to buy real estate from capital I raise, and we do some fix and flip stuff and rentals. I'm able to buy notes from the capital I raise, also performing, non-performing, first, second, and I'm able to buy tax liens. So I can deploy capital wherever the opportunity is at, and I'm not just stuck in one market. When COVID came, a lot of guys that I know who ran multifamily syndications, they had to stop paying investors, build up the reserves. They didn't know what was going to happen. Investors didn't like that. People who lent private money couldn't lend money at the time. People who borrowed private money for them, was getting deferred payments. It was just a mess. And we were able to continue to go because 85% of our rental portfolio is Section 8, battered women and children. These are areas that I come from. So I try to buy properties that are in these areas where I can make an impact to the community, putting them back on the tax roll. And in turn, I have a Section 8 tenant that's almost a guaranteed payment every month. So having that diversity in one pool kind of helps us with a lot of things as well. I know I said a lot.
So many ways we could go with this. Go ahead, Chris.
So first is before he got into construction, he had a full head of hair before dealing with contractors. Curiosity, because you mentioned it's very generous of you to, your model as well about working in other communities and so forth. And a few comments, and I'll have a question for you is, and one of the things I think about note space too is what most people don't realize when they get in this space, keeping the borrower in their home is going to be the most profitable for you as well. So you want to work with them, and it's going to, at the end of the day, you're going to do much better off in 99.9% of the case when you try and keep them in that property, and you do keep them in that property. I just want to mention that. Quick question I wanted to ask is, do you also get involved in opportunity zones or any of those programs?
That's a great question. I looked into that, and I think I had brought that up to my SEC attorney. I was like, hey, they're doing something in certain areas of the country, and these areas where I'm investing in, areas that were the hardest hit and need the most help to revitalize. And I think this is a great opportunity. So we did some research, and I think he did some certifications and got himself up to it, because a lot of people, it was uncharted waters. A lot of people didn't know.
Yeah.
So we looked into it, and to answer the question, no, I don't have anything opportunity fund. I looked to do that. It was just so complicated. It's a long term. At the beginning, it was complicated, but then as time went by and more people talked about it, got more familiar with it. The issue with me was that it. I looked at it as it being successful as a single project. So, for example, I
Mm-hmm.
went into a community and took a old school or something and turned it into a hotel, or
Mm-hmm.
just did something where it was one project
Mm-hmm.
where it would take 7 years and then we can exit, 7 to 10 years, whatever, then we can exit. The problem I had is I wanted to buy multiple properties in the Opportunity Zone Fund,
Mm-hmm.
right? But then I'll be selling, trading, doing a whole bunch of different things.
Mm-hmm.
And that's where it got complicated. When I exited, how would that be treated from a tax perspective? So these were things that you had to hold on for a long time. Then I could have bought a pool of properties and held onto it for 7 years. The deal is that in our space, for me, the funds that I've always ran have been 2 to 3 year terms.
Okay.
I've never run a fund where it was 5 year terms. For
Mm-hmm.
me, it's most people that I meet, they want to be in and out in the shortest time possible, and they want to capture the highest yield possible. Usually, if you're doing 5 years and you have a multifamily deal, where you have a 5 year plan, but in the space where I was doing flips and notes and everything else, the max time was 3 years. So it was kind of hard for me to wrap my head around creating a model that would last for 7 years,
Mm-hmm.
or have a people wait for 7 years. And then really, when I looked at the avatar of the people that I was networked with, a lot of the people had invested in multifamily or different things to kind of get that depreciation. So it just didn't fit my model. I wish I would have had the opportunity to jump into it, because I believe I would have raised a lot more money, because there are a lot of people who's looking to, defer those taxes or to get a tax break.
Mm-hmm. Yeah.
So so many things that come to mind for me here, but I mean, one thing that really stands out is that obviously you now know how to do a ton of different things within real estate and notes and all the niches within the niches, if you will. But it's easy for somebody to brand new to listen to this or watch it and think, oh, I'll just do everything and be really good at everything, and and honestly reminds me a little bit of your approach reminds me a little bit of, we had Dave Van Horn on the podcast a few months ago, and he's been in real estate and construction and notes and seconds and firsts and everything over the years, and but the takeaway for me is that you were focused on one thing at a time. So you were focused, and you got really good at that asset class, or that you were doing flips for a while and rentals and then seconds, and but now you have the ability, like you said, to pivot, so that you're in a much stronger position when market conditions change, or legislation changes things, or whatever happens, you're able to pivot because of the focus that you applied over a long period of time. I don't want to miss the point that it was a long
It's
period of
very
time that you've been
important.
doing this.
Very important. Even
So
now, go ahead, go ahead.
I was just curious, what does it look like now as far as your business? I know you mentioned your fund. Is it just you? Is it a one man show, or how do you run your business operation?
We have a team. We have about 11 people. That's including all our virtual assistants. I have about maybe four virtual assistants that we leverage from the Philippines. And that has really been a really good pivot for us also, to kind of be able to have people on our team that is a day ahead of us. So when we wake up, things are already getting done in the next day, while everybody else is trying to figure out what's happening tomorrow. We got people already working on tomorrow. So I love that part of it. Um, yeah, it's a team effort. It's really tough to do it all by yourself, right? There's been many days where I've said, "Hey, I wish I didn't have a team. I wish I was. It was just me." You go through the frustration, because the biggest problem in this business is
Mhm.
people, right?
Yep.
Just to be honest.
Chris and I can
We
relate.
It's any
I
business.
think
Let's
my
be
biggest
honest.
problem
Yeah.
is, and I come to realize this, that I expect everybody to be like me and do things like me. And that's where we go wrong. That's where the frustration comes. But what I've learned over time, you can train someone, you can hire somebody smarter than you, first of all. So that's what I started doing, hiring people who are smarter than me operationally, right? Because I'm not an operations guy. I'm a deal. I go find deals. I go raise capital. That's what I'm good at. So I've worked people on a team who can help me operationally, people who can help me build systems, processes. Even with onboarding and training, I think that's important. I think in the very beginning, I went wrong, putting the wrong people in the wrong seats and not having a system and processes. Just go, 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 go with that mentality that I had when I first started. But over the years, you learn that time is valuable and you learn how to put systems and things together. Give you an example, my biggest trade to date was 15 loans that I purchased from Banco Popular in 2016, I believe. I'm sorry, not 20. Was it 2016? Yeah, I think it was 2016. Yeah, I purchased 1,000 loans from Banco Popular, and it was a nightmare logistically. It
I can
Were you
literally
in Puerto
took
imagine.
me.
Rico?
It took me 2 years to get through that portfolio. 2 years,
Hmm.
sad because we just got at that time we were making. I got into business started a fund in 2013 and started to buy and buy them. Right before that, I just did small deals here and there on my own and partnered with a few people. And when we first started the fund, it was a small fund. It was $2 million, and at that time, you were able to get a couple hundred loans, at the most. But I never deployed all my capital. I would deploy a percentage of it. I would sell off the creme de la creme, the stuff that had most equity, that was current on the first. People would overpay for that stuff. I'll recapitalize on a percentage of my spend, and I would go repeat the same thing over and over again. And I worked the hairy loans, which actually made me a better note investor because I had to really fight with my back against the wall to figure out a solution for these loans nobody wanted. And those became the best loans to me because I was able to price them at zero on my trade, put the cost with the other notes and sell those, recapitalize, and then make crazy returns on the stuff that I priced low. So I used that model for a long time. But when we made the 1,000 note trade, it kind of broke us because we didn't have the right systems, tools, the right people in the right seats. So that actually started to teach me things about, setting up the business at like a franchise and having systems and things in place. And fast forward, now, when I look at it, even when onboarding people, we use a CRM that basically just automates this is the next step. You watch this little video. We use a system called Loom where you can record little short, small 5 minute videos. We use Lucid charts where we have process mapping and everything done visually, and everything is pretty much automated. And it's something we continue to work on. We just implemented EOS, Entrepreneur Operating System.
Mm-hmm.
That's a really good book that you want to get and read. It puts all your team on the same page on the same thing. So
Yep.
just learning things like that to keep structure will allow you to scale, right? So actually, one thing you mentioned, Dave, one thing I learned from him is you need three things in the note business. You need the money, where to buy the notes. You need the source where to buy the notes. You need the money to buy the notes, and scalability. That's very important. You need to have all three at the same time to be successful. I think that's in any endeavor. But yeah.
Yeah.
Yeah, that's one of the things I think people getting into space miss the mark on a little bit is, if to try and scale, it's not simple, and it's not just, hey, I've got money and scale. It's money, it's systems, and really to make it in this business, you got to have that scalability. Trying to, when you look at it, if you got $100,000 to invest in this business, great, you can make 25%, but 25 grand, when you look at all the effort and work that you're putting in, and then take off over your overhead costs and stuff, you realize you're probably paying yourself the same as a low level, employee in some company in some aspect of it. But I wanted to ask a question, focus a little bit on seconds, and just curious, where you see that space, because a lot of people like to try and get in the seconds because it has a lower acquisition cost. And I know, I don't see a lot of seconds, being written at this point in time. I mean, you do see lines of credits and stuff, but just curious overall, because like I said, we talked to Dave. He had his opinion on where things are going and stuff. I was just curious from your perspective where you think you see the second space headed in the next few years if you had a crystal ball.
Yeah, so for me, I still love this space again because it's like an option. right? So
Yeah.
I have an option on a property
Mhm.
where, and I buy seconds on properties that are, the first is like $250,000 and more,
Okay.
right? So that's the model that we have. We may have some where the value is maybe 180,000, something like that. But typically we target 250 or more. Um, and they nowadays, of course, everything has equity now because the market is crazy. So
Right.
it's hard to find something with no equity. But back then, it was stuff that you bought all types of stuff. When you buy a pool, you got to take the good, bad, and ugly. I still like seconds today because, as I mentioned, it gives you an option on a property where you can foreclose subject to first, and you can still control the property. You can still rent it. The insurance is being paid by the first mortgage. There's a variety of things that I can go through why I still like seconds. There's a lower barrier to entry, more diversity. There's risk as well. If you don't have equity, you can get stripped,
Mhm.
crammed down. There's a list of bad things I can mention as well. It really, first versus second really depends on how much capital you have to deploy. So if you are one of the big funds like PPR that raised 100 million plus, it's really hard to like. It's better to buy first in REOs than to buy seconds because you're going to have 10,000 seconds, and it just becomes work. Second mortgages is a business, right? You really have to have a team. Systems is a business, and you look at it and you say, I'm going to pay five, six, $7,000 for legal, right? Why would I pay that for 10 loans when I can pay, the same amount for 3 loans and I get a better result? I may get the property and it turn into an REO and I can sell it. So it all depends on, where your capital stack is at and what you're deploying that capital into and the velocity that you need to do it and on which investment you want to go with first versus second. I think having a blend, we have some first as well. I think having a blend is good. Like for me, I'll learn something, create mastery in it, build systems for it, hand it off to someone else, but still play in that space, right? So as I mentioned
So,
now, go ahead.
sorry, I mean to cut you off there. I was just curious to piggyback on that as far as due diligence for a newer note investor who maybe has, 1 to 5 first lien notes. What's the primary difference? I know traditionally you hear seconds. You want to look at the borrower a little bit more than the property. Obviously, the first is a little bit closer to the property. Um, maybe that's changed given the unemployment issues with due to COVID and that kind of thing. But what would you say is the primary difference between running due diligence on a second note that you're going to purchase versus a first for the newer note investor out there?
Yeah, for me, I like the fact that I start off in seconds because the due diligence is heavier in seconds. Like with the first, is just okay. What's the property worth? If I had to foreclose, this is my cost. If I can save the borrower, great. But more than likely, I'm going to end up with the property. So let me put more of my focus on that, right? With seconds, as you mentioned, it's both. You have to look at the property and you have to look at the borrower. So it's more due diligence that goes into a second than a first. And oddly enough, it's cheaper to do due diligence on a second than a first.
Hmm.
Because at first you have to, you're going to run title, you're going to do a whole gamut of things to make sure the property is intact and everything is good. Whereas the second, you're right under the umbrella, under the first, as long as it's current.
Mhm.
But
Mhm.
there's more due diligence, I believe, that goes into seconds than first. If you learn that, then really doing the due diligence on the first is easy. I think the challenge most people have coming from seconds to first is the title,
Mhm.
understanding title and understanding forced place insurance and those other things that you need to have in place immediately as soon as you foreclose. The taxes, making sure there's no tax sale certificates because that can wipe you out. So understanding that part, which most second investors don't focus on as long as it's current, they just say, let me just focus on the borrower, a little bit on the property, and then I'm just going to make sure they have the ability to pay, and that's that. But it is more due diligence in seconds, I would say. But the crystal
Makes
ball
sense.
question that Chris asked, I think
Oh,
that
sorry.
there will always be seconds available. There are collapsed bonds. There's still bonds that's still collapsing. You have 30 million UPB trade out. That can be a couple of hundred loans that will take years to kind of go through. So there's still big funds that own these things that's able to buy them higher up. There's still HELOCs being done. People are still doing second mortgages. As for not as before, it was originating first and seconds. Now people are doing home equity line of credits, which are collapsing, and there's still opportunity out there, I believe. It just depends on how high up on the scale you are if you want to buy it, because you're raising $100 million. It just doesn't make sense,
Yeah,
to buy.
that's the one thing that I see a lot of people, I think, get too nervous or worried about is, if you're playing with a few $1,000,000, in a $11 trillion mortgage industry, it's like, a tree on the earth, it's like, it's such a small component to it. You're never going to have, pretty much never going to have issues with product. I mean, in the first space, which is where I deal mostly, people say, oh, it's tougher to find first. I've never had problems finding it because I'm not trying to buy 50 million at a time. Now, if I had that capital, yeah, maybe it'd be a little more struggles and so forth. One of the things also that I've heard about the difference between first and seconds, which kind of also fits, my personality. People say seconds you're more a therapist, where you have to have patience, and first it's like, it's more just systems and analytics of the property and so forth. And for me, I have zero patience. So even my attorney says, he's like, please don't ever get in seconds. Please don't ever get in seconds, because you do not have the patience on this. I was just curious your thoughts on that.
Yeah, that's true. Absolutely, 100%. It's a long-term investment strategy.
Yeah.
Here's what I liked about seconds. A buddy of mine said, try this strategy out, Fuquan, when I first got involved. Sherman Arnovitz. I don't know if you guys know Sherman.
Yep.
Try this strategy out. I said, why would because we had like a quadrant. Mm-hmm. And in the quadrant, we had different types of seconds, right? Current lender first with equity, current lender first, no equity, not current lender first equity, not current lender first, no equity. I said, why would somebody buy something not current on the first with no equity? He said, okay, let's look at these loans. Average UPB is 25,000. There's no equity in it. The first is foreclosing. The person may be trying to work out a loan buyer. You don't know. He said, I'm going to buy these loans for, I don't know, at the time it was maybe like 6 cents on the dollar, right? So we bought a loan for 6 cents on the dollar, $25,000 UPB, less than, $1,000, almost $1,000, whatever that comes out to be.
Yep.
Did a mail campaign to these people and said, hey, for $5,000, we will eliminate your $25,000 loan. So 60% of people responded to that campaign and paid the $5,000 on a loan that we pay like $1,200 for. And I'm going, oh, I get it, right? It's
cool.
It's strategy, right?
Yep.
So I said, okay, let me focus on these loans where everyone is running away from these. Let me buy a boatload of these. And then I started to then learn unsecured. So when people would say, oh, you get wiped out in foreclosure, you get this and that. And I'm going, okay, as long as they didn't file bankruptcy, they still owe that money. And I just started piling those up and then gave them to a collection company to start a collection process, and gave them, post-judgment, it was 20%, pre-judgment, it was pre-judgment 20%, post-judgment 25%. And they got a percentage of it. And we were able to work on even stuff we got wiped out and the first foreclosed on us, and we thought it was the person never filed bankruptcy, so we thought it was over. We were able to collect on a lot of that stuff. And then in that 1,000 pool loan I told you I purchased, I got more loans for like free. A lot of this stuff it just gave me a whole portfolio. And in that portfolio was auto loans, credit cards, people when they open up checking accounts and bounce checks and they owe money. I got some of that stuff. So you can pretty much collect on a lot of different things, right? And I learned collections by navigating through that pool, and the different things, like I said, that I learned from one of my mentors early on, the type of that. And that's why I like seconds, because this is just a variety of ways that you can collect on it from the, when you say you have to be a therapist and everything else, a psychologist or whatever, working with people to create a solution. That's what I liked about it. And we foreclosed, we failed, right? Foreclosure was not our model. You mentioned that earlier on in the show, Chris. For me, it was important to work something out, keep that person in a home, and collect the payment. It was a win-win, because I didn't want to fly to, Arizona, Texas to rehab a property. And even when we did foreclose on something, we turned it back into a note. We found local boots on the ground. We marketed the area. We hit the Facebook. We hit the LinkedIn, the meetups, and basically we found someone who we can own or finance it to, and we turn it back into a note, interest only for 5 years, and
Mhm.
that gave us the ability to do that.
One of the things that caught my attention through what you just said is the having an open mind and being creative in this business can lead to significant returns on things, because like you mentioned, take the unsecured stuff, people look at that and be like, it's unsecured, forget it. But people don't look at, well, yeah, it's unsecured, but this person has 7 other rentals that they own. This was a strategic one they let go. And oh, by the way, they got 6 other properties that you all of a sudden go pull credit on them. There's very little mortgages on those. It's like, wait a second, this guy's got some meat behind him, and you're picking some of this stuff up for a penny, few pennies on the dollar. It's once they realize that, or they, that, they come to the table pretty quick, is what I found on some of that stuff.
Yeah, you can sue and get a judgment and
Yep.
put liens on other properties. A lot of people don't even know about the suing and the note aspect. I
Yep.
was
You
doing
you
that
did
earlier
a
on.
did you did it? Was it the Cash Flow Expo? Was that your presentation? Something. One of these
So
events I
yeah,
saw
yeah,
recently.
yeah, and I've been doing that for years. A
Yeah.
lot of people to this day still go the foreclosure route, and I'm like, dude, why would you spend all that money doing foreclosure? Like even now, I have a few tenants that's not paying, that's not Section 8, and even though courts have a moratorium, I'm suing and getting money judgments before
Mm-hmm.
they go to court and get an eviction date. I'm getting money judgments in order to negotiate cash for keys to get them out, but
Mm-hmm.
I've been using that sue strategy for a long time because you can put judgments against everything that they own, and
Mm-hmm.
it's faster to get a suit than a foreclosure. They get
Yep.
a judgment in a lawsuit. In my state, it is. And
Well,
in the different states I found as well that I do that, and it's faster
and
than
also,
foreclosure.
yeah, and also if the property's got very little, equity on it, it's what you're spending all that money on foreclosure for what? You're not getting any benefit from it. So, at least you get that money judgment, there's that other aspect of it. So, nope, that's
So Fuquan, you just mentioned. Sorry, Chris,
no,
cut you
that's
off a
fine.
little bit there. You just mentioned states. I was just curious. Which do you avoid certain states? I know newer note investors generally head toward the non-judicial states, and I think you reside in a very much a judicial state, I believe. Um, how do you determine which states you're going to target, or has that changed over time?
Well, it's where we have the biggest footprint. What I learned a long time ago is you want to focus on where you have the biggest footprint, when you own the most assets, because you're going to be dealing with the legal counsel a lot in that state. So what we did earlier on was we looked at our portfolio and we said, okay, we own a lot of loans in Florida, so let's just focus on selling a lot of the stuff that we had, maybe 2 or 3 in this state, and focusing on the stuff that we had at least 10 or more loans in that state. And as time went by, we kind of upped that number of, okay, let's sell those 10 loans. Let's focus on states that we have 25 or more loans in and get rid of the rest of those. And that's how it just came down to maybe 4 or 5 good states that we kind of focus on. But we still buy in all states and try to
Mm-hmm.
see if it goes to our funnel. We send a letter out, this kind of payout, whatever the process that we have. And we stopped selling loans a long time ago. So that should be part of our process. We'll bring it in, clean it up, board it with a servicer, put it out for sale. The lowest hanging fruit, the stuff that had more equity. If it didn't sell for the price we wanted, then we would bring in the house and we'll work it. We'll send out a demand letter. We'll send a private investigator. We went through a process to try to see if we can create communication. Then if we couldn't, then we would probably put it out for sale again or continue to work it while it was out for sale. I mean, that kind of helped us get to a few states that we have a good legal footprint where we have 3 or 4 different attorneys. We're learning stuff organically and continue to do that. So that's where it kind of go to
Yeah.
now. But we still buy nationwide because the banks don't let you cherry pick,
Mm-hmm.
and you got to buy it
Right.
all. We usually we know the buyers what states they like. So if I see I'm taking on a trade and it's a lot in Texas or a lot in Arizona. Everybody wants California. I'll call my California people where I know they'll pay 150 cents on the dollar and they'll, hey, I got some California loans coming.
Right.
And
Yeah,
Yeah.
it blows my mind when I see trades for like 110 cents on, 110%. And then I realize, the coupons are at like 7%, and, it's an insurance company or somebody else who they're happy with 3 to 4%. I mean, money's so
yeah,
cheap
yeah,
nowadays. It's,
yeah.
they're happy.
Preservation
So,
of capital.
yep,
Yeah.
exactly. So as we wrap up, Fuquan, one of the things we like to do is, offer people kind of a note and bolt, which is kind of a tip or something, that you've learned, especially for somebody newer in this space, something that they can take away that isn't usually, it's more something, a lesson learned from experience, not something you get from the proverbial textbook. So I was curious if you have anything you could share with the listeners.
Yeah, for sure. A mentor is important. I know that someone probably said that a bunch of times, but try not to look for a city of Chicago with a map of Detroit. I did that earlier on. Dave, actually, you guys mentioned Dave Anwan. He was my mentor when I got started in the note business. I had a conversation with him. We went out to lunch. I drove to his office in PA, and at the time they had like a training, and I was like, this guy's trying to sell me on training. I don't want to be a part of training. And I tried to do it on my own,
Mm-hmm.
And after a few months, I was like, you know what? I'm going to join a training. I'm going to get back out of that, back into the mindset where I should be and getting around people who's knowledgeable.
Mm-hmm.
And I didn't have to reinvent the wheel. I learned a lot from being around people in the space, get out, network. I think that's the biggest mistake a lot of people make is not allowing themselves to be vulnerable and show that they need help constantly. And I constantly do that. And I'm a part of three masterminds. I'm actually joining another one, which I'll leave next week. But it's not real estate related. It's more like personal vision mastermind. But I'm always look for things that will help you grow. That's a mentor or putting yourself in the right circle where you can grow. That's the biggest lessons I think I've learned today in my business.
Yeah, that's really good, and just it speaks to the fact that you're confident in what you do, but you're humble enough to recognize you don't know everything, and there are people who know what you don't know, so you can learn from them. And yeah, I think it when people are too hesitant to ask questions, I think it's often really pride, and they're not willing to be vulnerable. And so I imagine that's a big part of the reason you've been successful. I didn't mention it earlier, but I met you briefly at Paper Source in 2018, and I read your book, and it was very inspiring. So you've been an inspiration for me as well as getting involved and growing in the note space. So I appreciate it.
Thank you. I appreciate it. Yeah, I have 3 books out. Turning Distress into Success was the first book I wrote about notes, and I talked about all types of loans, auto loans, boat loans. I was back then like, oh my God, this is a great business. It's not just to pay the mortgages. You can put notes on this and cars and this and that. This credit card debt. Oh man. So I
Yeah,
wrote
that
that
was the
book.
one I read. That was good.
I wrote that book. That was a really good book. And my latest book is Passion for Real Estate Investments. It just talks about, what we just talked about, being able to diversify your strategy and learning these different niches within real estate and executing on them. So, and all those are on Amazon. I wrote one more book, was a pamphlet. Matt Kelly calls it a pamphlet. It's called The Tire Kicker. Because going to a lot of these events, and I'm guilty of it also, not taking action on things, but you go to certain note conferences and you see people 3 years later like, hey, you bought your first note yet? Not yet. I just need to get more information. And the only notes they have is the notes in the book that they're writing. So, but that's the last book I wrote. All of them on Amazon. You guys can catch it. Thanks for having me on the show. I really appreciate you guys. You can catch me on social media at Fuquan Bilal. NNG Capital Fund is the website.
Cool. Well,
Great.
Fuquan, yeah, thanks for joining us today on this episode of the Good Deeds Note Investing podcast. Jamie, any final thoughts?
Thanks a lot, Fuquan. This has been great.
Yeah. Thank you.
Awesome. Appreciate it, guys.
Take care.